And here we go. And here's like all the portfolios that we simulate. Here, for instance, this data point is a portfolio which has as a return 17% and as a Sharpe ratio 0.15. As you can see here, the risk involved was very high, so I guess this portfolio should be composed mostly of Tesla stock, which has high volatility with low return. Hello guys, first of all, I want to thank you all. I really love you all and thank you very much for your feedback regarding the last survey, and now I'm going definitely to change my channel name. Lately, I've been facing a lot of ups and downs in my personal life, and now I draw a big line out of it to have like a fresh and new start on the YouTube channel. Before to start, I have decided to offer to 10 people here on this channel a free lifetime access to a program that I'm going to launch very soon, which will be called Algo Trading 5-Day Challenge. For that, you just have to click in the link below the video and I will contact you by email and I will give you like a free access to this new program, which is going to be very deep and so interesting. However, there is only 3 conditions. The first one is that you subscribe to the YouTube channel because I want to give it to the first follower of the challenge first. Then, second condition is to give 1 hour a day commitment for 5 days in a row. And third, to be very motivated to gain skills and knowledge in terms of algorithmic trading. Okay guys, before to start, I would just require a little bit of your help for me to refine what would you like to see for next week. So I have 3 topics of videos that I want to share with you, and let me know which one would you like to see, and that will help me a lot also to make something which would be interesting for you. So the first one is how to invest in the market with $300 according to mathematics and data. Second one, the top 5 best way to receive alternative data. And the last one, AI bot using Markov chain. Let me know, and now I let you with the video. See you. Okay guys, let's start talking about the plan and how this video gonna be divided. The question that we're gonna try to solve is how can we use mathematics and science to optimize our investment portfolio. The goal at the end of this session is that each one of you can use these notebooks that we're gonna create to optimize your stock investment. You're gonna be able to bring your stock within the application we're gonna do. Let's say imagine you have stock of Microsoft, Google, and you have some Bitcoin. You're gonna include these stocks in order to be able to optimize the allocation of your portfolio. We're gonna start with a random portfolio with, let's say, a random weight on every stock, and we're gonna use mathematics in order to improve it. And to solve this equation, we are going to answer a first question within this video, which is gonna be how hedge funds and portfolio managers are leveraging mathematics to have a robust portfolio. And more importantly, how can we use it as a retail trader and investor? To answer this question, we're going to explore first of all what are the 3 main equations used for portfolio investment in today's world. And also we're going to explore the 3 main schools of investing our money. We're going to talk, for instance, about Ray Dalio. We're going to talk about Warren Buffett and what type of strategy are they using for the last 50 years in order to invest in the best way as possible. And at the end of this comparison of the 3 ways of investing, we're going to end up with the formula of a Nobel Prize called Harry Markowitz that we're going to apply in order to improve our portfolio. So now let's start with the first question, is how today hedge funds and portfolio managers are using mathematics in order to improve the way that they are going to invest into the stock market or just invest overall your money. Essentially, there is three ways of investing. The first one is called top-down. The concept of top-down methodology used by hedge funds is to look at the market through a macro perspective. A macro perspective, by contrast to micro perspective, is to look at the market through a macroeconomical perspective. For instance, if we go back in 2020, during the pandemic, a hedge fund which is going to invest into the market through the top-down methodology is going to invest mostly into the tech industry. If you take a look at the market through a macroeconomical level, the entire US society and the world are going to change their habits and to use more technology, which means they are going to work from home, they are going to change their habit, and there are going to be like a big change in terms of macro level of the society. The entire society is going to change. So by investing into 10 technological stocks, you are sure that one or two stocks are going to skyrocket. For instance, during the same time, Zoom took plus 500% and Shopify took more than 300% during this period because people change their habit, bought online. And by essence, if you have diversified portfolio into a macro level, you are sure to make profit into the long term. Other way of seeing the top-down methodology is in 2022, when the war between Russia and Ukraine started. It was interesting to invest into oil companies because of the beginning of the war, we start having the oil price being more crucial, and investing in 5 stocks related to the oil, you are going to make your profit this way. For me, it's something that you can use at home and something that I'm using. However, one of the key points here is like it's very hard to develop it in terms of algorithmic trading because you need to read at the news into a macro level. Like you have to read the Wall Street Journal every day to take a look at what's going on in the economy and understood which sector is going to rise in the next month. The second school of investing is called bottom-up. The bottom-up methodology is working by contrast of the first methodology. Is not working into a macro perspective. It's very different. It's working into a micro perspective. You are going to have different financial analysts that you can listen to it on CNBC or at the TV, and they are going to dissect different stocks of the US market. For instance, taking a look at the profit and earning ratio. This methodology is like what I'm calling Warren Buffett methodology. It's like always talking about profit and earning ratio to take a look if the company is going to be working well into the next 18 months. 18 months, 3 years, 5 years, 10 years. You are going to take a look at all the stock individually in terms of micro level, and you are going to select to do what we call stock picking of which stock have the most probability to rise based on the fundamental. It's also what we can call, maybe you heard about it, fundamental analysis. For me, I don't like this way of investing, but it's just personal. This school of investing is not my favorite one, but it's very personal. I prefer top-down, and top-down is much more related to Ray Dalio, which is another trader, which is talking a lot about law of large numbers, and for me, it makes more sense. So, and the third way of investing is what we call quantitative risk optimization investments or risk management based on mathematics. And you have two big formulae which are used by portfolio manager and hedge funds. The first one is called, let's type it this way, Black-Scholes formulae. And the second one is called Markowitz portfolio Markowitz modern portfolio management. That's the two big formulae that you can use if you want to use quantitative formulae in terms of investing on the market. That's the three ways that hedge fund managers are mostly investing in the market. Fundamental analysis, analyzing each stock and do stock picking. One is called top-down. How the world is moving into macro level and investing into the area which is going to rise. And in the third way is to use quantitative methodology and mathematics in order to invest into the market. And now the question that we have to solve is how us as a retail investor we are going to invest into the market. How are we going to take our money and invest into the market as a retail investor? To do that, in today's video, we are going to answer this question through the modern portfolio theory developed by Harry Markowitz. I prepared some slides on PowerPoint to explain you this theory, and we're gonna jump on it. Modern portfolio theory. Okay, let's go on to the slide. The theory that we're going to apply today is called the modern portfolio theory. The modern portfolio theory got invented by Harry Markowitz, on which he got the Nobel Prize of Economy. By the way, for your general knowledge, it's important to know that today we're celebrating the 1-year anniversary of the death of Harry Markowitz. To understand Harry Markowitz theory and the modern portfolio theory, let's imagine you have two assets. One asset A, which is going to be more safe. For instance, if you can imagine having the asset A in your portfolio, it can be Coca-Cola. You are a good father, you want to invest your money for the long term, you are going to buy Coca-Cola stock. Coca-Cola stock are going to be safe on the long term. However, the return is going to be very limited. On the other side, you have an asset B, which is going to be more volatile. For instance, you can imagine an asset B as a tech stock. For instance, you are going to invest in NVIDIA or you are going to invest in Tesla. Tesla or NVIDIA have high return overall over the last 10 years. However, you have very big exposure to risk. And if we combine asset A and asset B in portfolio, we can imagine the risk following the return through a straight line. For instance, we have an asset A with 15% return, which can be Coca-Cola. However, the risk would be 20%. On the other side, we have the asset B with 30% return and a risk of 32%. If you want to calculate the return of the portfolio, it's very easy. That's going to be, here we go for the calculation, that's going to be the return of the asset A multiplied by the weight which is going to compose your portfolio. If you have a portfolio fully with asset A, we are going to get 100%. On the other side, if we go with 80% asset A and 20% asset B, we're just going to have 80% times 15, 20% times 30, and we're going to get the return of the portfolio B. If we show that on a graph, we're going to get a curve which is going to look similar to that. However, if you say that, you are assuming that you have a correlation of 1. Here's the degree of correlation. Why? Because you are assuming that when asset A is going up, asset B is going up, and conversely, if one is going down, the other one is going down. Right now, if we start having some stock which can be uncorrelated, what is going to happen? We are going to get, for the same risk exposure, a better return. It looks magical. To understand the concept of correlation, let's take these two individuals. A first individual A, that we're going to call JC, and second individual B, that we're going to call James. Both of them choose to diversify their portfolio. JC, instead of only buying stock of Microsoft, he chose to buy stock of Apple and Google. By another side, James, who is a little bit more smart and read Red Halo theory on multiple weather portfolio, got a portfolio composed by 4 different assets: Microsoft, Coca-Cola, little bit of gold, and some cryptocurrency. On both cases, they will get the same return at the end of the year. JC gonna get his 25% return at the end of this first year, whilst James also gets his 25% return at the end of the first year. However, if we start calculating the risk of each one of the portfolio, now imagine we have a technological bubble like in 2003. What's going to happen? All the stock of JC are going to crash down. And on average, you can face a loss of 40% in a big crash. Or even, let's imagine the US economy is dropping a little bit. What's going to happen is going to lose 10%. By another side, if we take a look at James on his portfolio, if there is like a war or the US economy is going down, what's going to happen? Microsoft is going to face a big loss, let's say 40%. Coca-Cola is going to face a loss which is going to be a little bit smaller, 10%. And on the other side, the gold, instead of jumping by 15%, is going to jump by 30 to 40%, and the crypto market by 200%. So what's going to happen is going to be protected and get back his 25%. On the other side, the US economy is doing well. Microsoft, instead of jumping by 30%, gonna get 40%. Coca-Cola, instead of having 5, they're gonna get 12%. And gold is going to drop by 5 to 10%. And the crypto market, instead of having 55% return on this year, is going to make a bar 10 to 20% because the US dollar is getting stronger. So he's still going to have his 25% return over the year. If you take a look at it, both portfolios have the same return, 25%. However, because here we have a correlation which is close to 0, what's going to happen? You are going to mitigate your risk and have a risk which is going to be much smaller for the same return. Whilst here, because the correlation is very high, you are going to have like a risk which is going to be much higher. And so, if we continue on the graph, what we can see here, if we continue with like a correlation of 0, we can see that with 25% risk, we can target a much better return, which means getting more of the asset of the volatile stock, and so on, and so on. So, to understand well Markowitz theory, you have to keep in mind these two codes. The first one is not only about having multiple assets, but also about having assets with low correlation between them. And second one, it also involves thinking about your portfolio as a whole and not just asset by asset. For the second code, the best is to read the book of Ray Dalio, The All-Weather Portfolio. He's explaining that when you build your portfolio, don't just take the most interesting stock, but take a stock which are going to compete to each other in case of market change. For instance, if there is a new pandemic, do you have some technological company which are going to skyrocket? If there is a war in Ukraine, are you covered or do you have only safe stock which are going to be deprecated? If there is an economical crisis, do you have some gold on the side which is going to make your portfolio more stronger and to be sure to never lose money on the long term? Think about it as a whole and not just as asset by asset. And now, the question that we have to ask ourselves is how can you create this portfolio in terms of mathematical intuition as well as in terms of programming? To do that, what we're going to do, we are going to base ourselves on this graph. The graph is going to take a look at the return and the risk. And our goal will be to get the best return over risk ratio. And for people who have some background in finance, the ratio which show the return over the risk is called the Sharpe ratio. And what's interesting is like when you calculate the Sharpe ratio for one stock, you're gonna calculate your daily return divided by your average daily movement at one standard deviation. Without going too much into the mathematical part, it's the calculation. However, when you include another stock in your portfolio, the calculation of the risk gonna be calculated with what we call the covariance in mathematics. But no worries if you are not familiar with mathematics, I'm gonna go much more into details in this video. So now that we got some background in terms of Markowitz theory, let's start with the programming session. Let's draw a plan on how we are going to act during this video. What is going to be the data model in order to get our fully optimized portfolio. First, we're gonna have to select some stocks and to download the data from this stock. Let's call this step get stock. Once we get this market data and this market stock, let's say, imagine you want or you have right now in your portfolio different stocks such as Microsoft, MSFT, you have Amazon stock, and we are going to just choose and download your current market portfolio based on few stocks. Once we got the stocks, we are going to proceed to some data manipulation because as you are aware, we're gonna get raw data, and once we got this data, we're gonna do some manipulation such as normalizing the stocks, which means like going from a price to get it through a percentage change evolution. Because for instance, imagine you have 5 different stocks. You have Microsoft, which is like around $100. You have like some stock which is around $30. What we're gonna need to do between receiving the stock and the data manipulation gonna be to normalize it all the stock values that we have in percentage in order to be able to have like a more fair view of the stock evolution instead of having like different price here. Instead of having it in dollar, we're gonna have it in percentage change. Once we proceed to the data manipulation, we're gonna then have to get some statistical KPI that we're gonna use into the Markowitz formulae. I will call it Marco. It's like friends. So we're gonna need some statistical KPI such as standard deviation, STD. We're gonna need the variance, the covariance, and other statistical KPI. Once we get this KPI, we're gonna be able to proceed to a simulation of different data points. What we are going to do, we are going to generate thousands and thousands and thousands of simulation of different weights for our portfolio. So let's imagine at the beginning we have like a portfolio with 40% of Google, 20% of Tesla. What we're gonna do, we are going to, and like different stock, we are going to use different weight for any individual stock, and we are going to take a look at what is the optimal risk return. So here it's gonna be like a simulation once we get our statistical KPI, and once we proceed to the simulation, we're gonna optimize the perfect portfolio with mathematical optimization. I'm very impatient to start with you this video because it's going to be super fun, and most importantly, you can use it from now on, which means you can go on Robinhood or on your portfolio. Whatever the stock you have in your portfolio, you can go and apply this algorithm, and you're gonna have the most robust portfolio based on your risk and return. That means you are going to get the portfolio which is going to bring the best return with the lowest risk. So guys, now if you are ready, we can start by importing our first libraries. So we're gonna start as usual by importing pandas as PD. That's gonna be for data manipulation, and NumPy. That's gonna be to randomize our data. Once we got pandas and NumPy, we're gonna download Yahoo Finance as YF. If you are new in programming and mostly programming for finance, I have 2 recommendations for you. The first one, you can go on my Medium blog. Here, like if you go on the YouTube channel, here you have like, you can go on Medium and you can access here to my profile. I have different articles that you can dig into. And one of the articles, I gave full description on how to use the Finance API. That's this one. Yes, this one. Sorry, this one. You can click into it and you're gonna land in this page, and you have like full description with like all the different arguments and the code on how you can use the Finance API in order that anytime you can get market data. And if you are very beginner, I have like a online course just right here. You can have like a discount code and you can connect to Udemy. You can go on Udemy and you can access to the online course. If you see it's like 1,600 students already with 4.7 stars out of 5, and you have like a full course on how you can set up your machine for algorithmic trading, a full Python refresher course, data visualization, how to get live market data, and everything. So just feel free, and also I updated it like very soon, May 2024. So just go on it, and you have different application if you want to start with algorithmic trading. So now advertisement is done. Let's go back to our code. So we start with the libraries. So now that we got the libraries, the next step, if you remember, is to import market data. Before to choose which market data we are going to import, we are going to ask Chat GPT. Let's ask Chat GPT, give me, let's go with like a portfolio of 5 stocks. Oh, okay. Let's go with a portfolio with 3 stocks. Oh, no, let's go with 5. Give me 5 stocks from S&P 500. Random stocks, please. Up. Okay, so here we go. We have 5 random stocks that can be in your portfolio. We can take like some big ones because usually like most people have big stocks, like famous ones such as Apple, Amazon. So it's going to be a little bit more realistic because I don't know if there's a lot of people who have Home Depot stock, or we can go like randomly. We can do like a mix. So let's imagine you are like an individual, you bought stock from Amazon, Apple, Netflix, Procter Gamble, and Nvidia. It's going to be perfect. Okay, so now that we got this data, for instance, you can go on the article and we can start by importing our market data. So we're gonna start here by importing market data. Give title, heading, it's gonna be more fun. Import market data. As usual, if you don't want to retype the code, you can just download just below here the video. You can just download the Jupyter notebook, and I'm going to insert for you the name of the article. So you can just like click here and you can access to the article. So the first step here gonna consist of importing market data. Stocks that we chose were the following one. I'm very going random with ChatGPT. So we said Apple, Amazon, if I'm not wrong. Okay, let's go Apple, Amazon, Tesla, Nvidia, and Procter Gamble. AIPL, NVDA, PG, Tesla, and which was other stock? Amazon. Amazon is a good one, or we can go with let's go with Home Depot. Is like fun stock, HD. So we have 5 different stock. Like we can imagine we have like a good father, and we invest on the stock on this different stock. So the first step gonna consist of importing these stocks. So let's start with the first one. Let's start with importing stock for Apple. If you go in the article, I explain you that we have two ways of downloading market data. Either we can go with like period and interval. Otherwise, we can go with start and end date. To have the same, to be on the same page, we are going to choose the same date. Let's say we want the last 600 days and we want it in daily. Let's explore the data, if the data have been downloaded correctly. Okay, perfect. And the only data that we're gonna need is gonna be the date and the column close. So once we got this data, we're just gonna use the column close. We can call them each one by one, Apple. We can do that for all of them. Okay. Just change the name, NVDA, PG, Tesla, and hedge. You can optimize it by doing a loop. I just don't want to waste time right now. So PG, Tesla, and HD. Okay. Let's download the data. Now that we got our data, the first step in terms of data manipulation, let's create a new heading calling it data manipulation. Gonna be to select only the column close. So what we're gonna do, we are going to create a new data frame with, as an index, we are going to have the date, and for the column, we are going to have the close price for each one of the stock in the portfolio. Because what we have to imagine is like a portfolio with like different stock. We're gonna start with like a random weight optimization, which means like 20% for each stocks. And what we're gonna need to have in the first step is to have like first column date as an index and the close price for each one of the stock. So we are going to have like the price for each one of the stock. And once we're gonna have this price for each one of the stock, we're gonna be able to step up into the next step. If you remember here, the goal was to, in terms of data manipulation, to go from the stock price to normalized price. So first, we are going to start by creating this new data frame that we're gonna call, let's call it portfolio. That's the stock that we have in our portfolio. And this portfolio data frame gonna be equal to pd.concate. We are going to concatenate apple.colon close. Let's check. Okay, we have like a capital letter. Then we're gonna do that for each one of them. After that, we're gonna select nvda.close, pg.close, tesla.close, and homedepot.close. And we're gonna select axis equal 1. And if we execute and reprint our portfolio, we should have a new data frame. Okay, just fix that, and now it works. On the first column, we have like Apple, second, Nvidia, PG, Tesla, and Home Depot. What we're gonna do now, as you can see, is like very hard to read. So what we're gonna do, we are just going to rename each one of this column. So now we are going to rename the column. Just type portfolio.setAxis, bring the column name, and set axis equal column. And we are going to just type in place to replace it equal true. Okay, let's execute and let's print our portfolio.
data frame. Let's execute. And here we go. Here right now we have our new data as the first step of data manipulation. But if you can see here, it's still not fully readable in terms of mathematics. Our market data. The next step will consist of normalizing our market data. Indeed, you have to take a look at it through this way. Imagine you have two stocks. One stock which has a price of $10 and another stock here, stock A, and a stock B which have a price, stock B, of $100. If we take a look through a mathematical perspective, we are going to calculate two KPI. One is going to be, if you remember the Sharpe ratio is equal to the return divided by the volatility. And the volatility is just an indicator which is going to indicate you by one way to another the average daily movement. And here's the daily return. So let's go back to our stock A and stock B. We are going to evaluate them into two KPI. One is going to be the return and second is going to be the volatility. If we keep the stock in US dollar, as you can see, the average return that we are going to make is going to be completely uncorrelated in terms of number to the stocks. Even though the Sharpe ratio is still staying a ratio, it's very important when you have more than two stocks in your portfolio to normalize this value and the average daily movement in percentage of change regarding in percentage of change rather than keeping the daily movement in dollar. Because let's say, imagine we went from $10 to $12, which means a rise of 20%. And here we went from $100 to $105. In terms of mathematical perspective, when you are going to calculate your return, this return is going to be much more interesting. So the first step that we're going to apply will be to switch from getting data of all the value in US dollar, getting all the data in US dollar as we have right here, and move this data from US dollar to getting this data in percentage of change from one day to another. Because even the Sharpe ratio is going to be equal to the average return divided by the standard deviation of this population. But just keep in mind volatility. You will see just like one line of code to calculate this Sharpe ratio, so don't bother yourself with that. So the first step gonna be to convert the data from US dollar to percentage. Let's go. To do that, it's going to be very simple. We are going to create this new cell that we're gonna call normalization. Let's create it. And the only thing, as I explained you before, we need to move this data in US dollar. For instance, here we have some stock at $400, other at 150. We are going to move this stock from US dollar to percentage. For that, I didn't went that much deep, but you have two ways of doing it. Either you can work on percentage return. Otherwise, you can work with logarithmic return. Because the difference is so tiny, I would just base myself in percentage return. But if you want to sophisticate it, you can go with log return. I can do a small correction in the next video. If you're interested, I can explain you the difference between percentage return and logarithmic return, why you can choose one over another, but it will just be waste of time. Let's go to the point. So first point, if we want to be able to create our Markowitz model, would be to change this value in dollar in percentage. So to do that, we're just going to create a new data frame that we are going to call portfolio normed, and this normalized and this portfolio normalized is gonna be equal to portfolio divided by portfolio dot shift 1, which means like we are going to take this value divided by this value, and we're gonna get the percentage of change between each cells. So let's go with it. It should just, okay, I think we should just have 1 minus. You will understand why we need to have 1 minus this value, because portfolio, okay, boom. What we're gonna do, just in order to get it in full percentage, we're just gonna have 1 minus before, and here we go. Here between 29 to 30 of December 2021, the markets moved by 0.2%. Between this the 30 December and 31st of December 2021, this stock lost 0.12%, etc., etc., and so on. For instance, if we go on NVIDIA, we can see that in these days, the stock have taken 0.027%, and so on. Okay, so now what we have done right here is like we moved this data from US dollar in percentage, and now all the data are normalized and we can play with this portfolio. For instance, if you want to take a look at some data which can be fun, if you remember before we talked about correlation, that's something that we can build with it, is like you can just type portfolio normalized, and we're just gonna type correlation. Boom. And here we go. Here right now we have the correlation between the different stock. As you can see here, Tesla is highly correlated with Apple and Nvidia, because they're like both of them are like technological value, and Apple and Nvidia are highly correlated, which means when Apple go up, Nvidia go up. By another side, you can see that Tesla and Procter & Gamble are completely uncorrelated. They are working in complete different variable and different market. It's very interesting. So when we talk about having a diversified portfolio at the beginning through an arithmetic perspective in order to optimize our return, it's exactly what I was talking about. Okay, for instance, if you, let's say if tomorrow you want to go and analyze your portfolio, you can use this small line of code in order to correlation to optimize your portfolio. Okay, cool. So now that we got our KPI and that we got our portfolio normalized, we can go to the next step, which is going to be to calculate the value of our portfolio, which means like what is the Sharpe ratio of our portfolio. In order to calculate the Sharpe ratio, if you remember well, the Sharpe ratio is equal to the return divided by the standard deviation of the portfolio. To do that, we're gonna have to calculate. Okay, now is I'm going to call it Markowitz calculate Markowitz value, because that's the value that we're gonna have to optimize, what we call Sharpe ratio. The Sharpe ratio is going to give to your portfolio the more robustness. If you remember of the curve from Markowitz, the curve when you have a portfolio A and a portfolio B, you are not going to have like a straight line, because here our stocks are not correlated. We are going to have a line which is going to look like that. And what we're gonna do, we're gonna try to optimize to get the more return with the lowest risk. Up here is the return, here is the risk, and the goal gonna be to optimize this value. And the value which represents what we have between both is equal to, for each point here, what we're gonna have is a Sharpe ratio, which is going to be equal to the return divided by the risk. So what we look to have is like the lowest risk as possible and the highest return. So what we're gonna do, we're gonna have to work on improving our Sharpe ratio. So let's do it. Our Sharpe ratio, if you remember well, our Sharpe ratio is equal to our net return, is like the return of the portfolio minus risk-free rate, is like the net return that we're gonna get in our pocket, divided by the standard deviation of the portfolio excess return. We're gonna go back in this term in a second time. So the Sharpe ratio gonna be equal to the net return of our portfolio, how much we're gonna get from our portfolio, divided by the standard deviation of the portfolio. Or like, let's call it standard deviation of the risk of our portfolio. So we're gonna have two variables to calculate. The first one gonna be the net return, and the net return of our portfolio gonna be equal. So in this case, let's say for the first value of our portfolio, we're just gonna take the assumption that we have 20% of Apple, 20% of Nvidia, 20% of Procter & Gamble, Tesla, and Home Depot. So the first portfolio that we're gonna simulate is gonna be 20% of each one of them. So the net return is gonna be the average return multiplied by the number of sessions per year, multiplied by the weight that we have for each one of them. So let's do it this way. That's gonna be average return here. That's going to be a portfolio normalized dot mean. That's the average return that we get in one day. Because here, as you can see, we have 600 days. And what we want to know what is going to be our yearly Sharpe ratio. So here we have the mean return. And let's say, for instance, if right now we just print the mean return, what we can see here, we can see that we lost money for Apple, Nvidia, Procter & Gamble, and we made money for Tesla and Home Depot. The opposite, let me fix that. We have made money for the three of them and lost money for these two of them. Let me check up. Ah, yeah, here we go. If you take a look at it here, yeah, here like we lost money and show profit, and here we made money and show a loss. So the only thing what we're gonna do, okay, just like an opposite sign up, because if we calculate, let's make quick calculation to confirm. Let's have 409 divided by 410. And if we have 1 minus that, should be, okay, yes, sorry. It should be a loss of 2%, not a win of 2%. So just like small issue in the calculation, the only thing what we're gonna do, just gonna make it at the opposite. It's like 2% difference, but at the opposite. So we're just gonna do it this way, and we should have fixed the issue. Boom. Okay. Boom. Now it's all fixed. Now it's like a loss of 0.2%. So, and we have to multiply by 100. Tag. Let's check that, and that should be correct. Like here, like during this day, the stock lost 0.22%, which what have to be shown. Okay. So now that it's fixed, let's check. Okay, now it's good. We have our portfolio return. And here we go. So if we consider that we have 20% for each one of them, what we're gonna do, we're just gonna multiply each one of this value by some weight. And the weight that we're gonna apply for this first simulation, we're just gonna consider that we have a portfolio of 0.2 for each one of them. For each one of them, just as a first example. So 1, 2, 3, 4, and we have 5 stocks. So if you multiply that by 0.2, and after what we're gonna do, we're just gonna calculate the sum. We're gonna use NumPy to make the mathematical calculation as quick and fast as possible. Up. And here's our average daily return if we have this portfolio composed by 20% of each one of these stocks. So, and now what we're gonna do, we're just gonna multiply by 252 market session per year, and we're gonna have with this portfolio a return of 11% in 1 year. So, and this portfolio is not optimized yet. So let's continue. Here we go. Here we have our weight. We're just gonna bring our weights into a variable that we're gonna call weight. Up, let's up, and let's try. Okay, weight. Okay, weight. Up. Good. So now for our Sharpe ratio, we have our net return of our portfolio. If you go in the definition, the first one is the net return. Return of portfolio minus risk-free rate. Okay, so now we have our net return. And second variable to calculate is going to be the standard deviation of the risk. When you are going to calculate the Sharpe ratio for only one stock, what you're going to have to do is just going to take the, instead of having the mean, taking the standard deviation. However, when you have a portfolio composed by multiple stocks, I'm gonna have to use what we call the covariance. What is the covariance? In few words, the covariance corresponds to a variable which is going to give information regarding the direction of each one of the stock. For instance, here we have a stock A, and here we have a stock B going this way. Here, let's say, imagine that can be Home Depot, and in blue that can be NVIDIA, because they are not correlated at all. In this case, you are going to have covariance value, which is going to be negative, lower than 0. That's going to be something negative, let's say minus 0.52, for instance. And by another side, if we have this third stock that we are going to call Microsoft, if you take a look at it, between NVIDIA and Microsoft, you are going to have a covariance which is going to be above 0. And if you remember well, what is going to be our goal right here will be to have our portfolio which is going to be as much robust as possible in order to get the most efficient portfolio, to be the most diversified. That's why we are going to use the covariance. And if you go into the details of the calcul in terms of portfolio optimization for the Markowitz model, you calculate it with the transpose of the weight of your portfolio that you're gonna multiply by the sum of your covariance multiplied by the weight. It's the only thing that you have to keep in mind is this formula. I don't know who built this GitHub, but it's super useful. You should take a look at it. So let's go back into our calculation. So what we're gonna do is calculating the standard deviation of the risk, which is going to be equal to, when we have a portfolio, the standard deviation of the risk is going to be equal to that. The transpose of the weight. So we are going to use weight that we're gonna transpose, which means when you transpose the weight, that means like instead of having inline, you have it straight. And this weight that's going to be transposed, we're gonna have a sum of different matrices. So no worries for people who are not too much into mathematics. So nothing what you have to do is just to have a product of different values. So the first calculation is like the weight transpose, that we are going to have the product np dot numpy dot to have the product of these three. So np dot weight transpose multiply the sum, so another sum, np dot of the covariance. We're gonna take portfolio normalized dot cov that we're gonna multiply by the number of days with the weight. Okay, I think it should be good. And what we want here is going to be the here that's going to be squared. So what you're gonna have to do, just gonna have to calculate the square root of this product. Okay, let's print it, and we should get a value. I think there was an issue with the transpose here, with the transpose of the weight. Let me check how to get the transpose with Python. Okay, already been on it. Okay. NumPy transpose. Okay, NP transpose. Okay. Let's take this line. Let's try it here. Up. Let's create something that we're gonna call up. Let's print it. Okay, now we have the transpose of the weight. So let's call it weight transpose. Up, and let's bring it here. Weight transpose. Boom. Okay, cool. So now we have our net return and our standard deviation. And now if we calculate our annual Sharpe ratio, boom, we have annual Sharpe ratio of 0.4. Obviously, our portfolio is not optimized at all. We have mostly technological stock, which means that we have like a covariance which is high. Most of them, they go in the same direction. And what we are going to take a look now, and what we're going to have to do from now on, going to be to optimize this portfolio and not have 20% weight for each one of them. So we're gonna go to the next step. Let's say right now, if we go on our Markowitz model, we have two axes into Markowitz. One is the return rate, and the other one is our risk. And for our first portfolio composed of 20% of each one of the stock, 20% each, we got our first data point where we had a net return of 0.11 and a covariance, a risk of 0.28. So if we go here, return of 0.11 and a risk of 0.28. So our portfolio that we built right here, composed of 20% of each one of them, going to create like a data point which is right here. High risk, correct return, 11% for a risk of 28%. So what we are going to do right now, we are going to create different portfolios with different weight. Instead of having 20% for each, we're going to create a simulation with different values of portfolio. So what we're going to have like new portfolio with new value. And what we're going to look for what is going to be the portfolio which is bringing the best return with the lowest risk. I don't know if you see what I mean. So what we are going to do right now is just create thousands and thousands and thousands of different portfolios in order to take a look what's going to be the best combination of stocks. Let's say, imagine today you have a portfolio composed of $1,000 and you had $200 of stock in Apple, $200 of stock in Home Depot, $200 of stock in each one of them. Based on the Markowitz formula, we are going to rebalance this portfolio in order to have the portfolio which is going to be the most robust in terms of crisis of whatever happened in the market. So that's going to be the next step. We are going to simulate this portfolio. So let's do that. So now let's just first of all make a little bit of cleaning. Let's call it boom cleaning. we're just going to bring all that within one cell, because just stuff that we do one after the other. So up, covariance, up, it's not, we can call it expected variance. This one's gonna be expected return, and on the top we have weight and the weight transpose. Okay, so now instead of having one variable which we're gonna call weight, we're gonna ask Python to create different weight values. So this weight variable is gonna have to change. This one we're gonna call it weight transpose. So we're gonna have to work in terms of simulating different weight value. So to do that, it's going to be very simple. So what we're gonna have to do here is just ask, instead of having values of 2, we're gonna ask NumPy to create an array of random value of random. We have 5 values. For instance, here, let's see what it's going to be. Sorry, up. Let's have something clean, up, and let's execute. Let's print the new weight we're gonna have. Okay, so now we have 5 different weights. 60% of Apple, 69% of Nvidia, 44% of Procter & Gamble, 71% of Tesla, and 59% of Home Depot. So once we're gonna have this weight, the only thing that we're gonna have to do is just dividing this weight by the sum of this weight to have something which is going to be normalized. So weight we have on our portfolio, up, and let's print it, and now we have something normalized. So 20%, 17, 25, 30. So that's something which is going to have more sense. Now up, we can just like resimulate. As you can see, we can have different weight. What we're gonna do, we're just gonna create what we call a seed right there. So we're gonna tap random seed. The fact to have like a seed, I'm not gonna go too much into explanation of how the seed work, but the advantage is if you write down a number, for instance, for me, I'm going to write down the number 700, which means like if you type the same number of seed, you're gonna have the same random values as I get. So for instance, here that's gonna call it seed call. Let's take a look what this seed will bring as a value. Up. Okay, and now if you see, each time that we're gonna reshuffle, we're just gonna have these random values. So here we got a new one. If you test with a new seed, for instance, we are going to have another random value. Okay, for me, let's go with my birthday. It's 15th of July. So we're gonna go with a seed of 157. We're gonna have this weight. So now we have a new weight randomized. So if we call this seed, we're gonna have up, and what we're gonna do, we're just gonna bring back this formula right here. Just gonna give some details of the code. Here's like, we're gonna call rebalancing to 1. Here's like weight randomize value based on seed, and let's print it, and we're gonna print the weight value to be sure that we are all right. Up, and we're gonna print the weight rebalance. Up, we're gonna call it weight rebalance. Up. We're gonna call it this way, just to have like few check on the weights. Okay, the transpose doesn't matter. Up. Okay, we are printing the net return. And now let's execute and let's calculate the new Sharpe ratio. Boom. As you can see, this portfolio looks to be a little bit more strong. We went to a Sharpe ratio of 0.5. If you want to take a look at what is the value of the Sharpe ratio, you can just go on Google. What is a good annual Sharpe ratio? Usually, any Sharpe ratio greater than 1 is considered acceptable to good by investor. A Sharpe ratio higher than 2 is rated as very good, and a Sharpe ratio 3.0 higher is considered as excellent. So you have your value. Let's go back to our calculation. Boom, here we have our new Sharpe ratio. So here, what we have right here is like, did we print the, okay, we have to print it. Okay, print. I'm gonna print the standard deviation risk, and we're gonna print our net return. Up, here we go. Here right now we have a net return of 0.36 and a Sharpe ratio of 0.72. So we got 36% return, but the volatility of our portfolio is 72. So if we go back in our curve right here, earlier we had the first Sharpe ratio, which was at 11% return for 28% risk. And now we have the new Sharpe ratio, which is going to be 36, roughly here, with this type of risk. And in between, you're going to see we're going to have different stocks which are going to move. And we're going to try to find out what is going to be the optimal. So now we created it a randomized portfolio. Let's go to the next step. And on the next step, so now let's run the simulation millions of times. We are just going to rerun this entire simulation, but let's execute it right there. Okay. So let's remove all the prints because we're gonna run it millions of times. It's gonna have no sense to print them. And what we're gonna have to do, we're just gonna have to create like a function which is going to replicate every single step. We have to remove the random seed because what we want right now, we want to have just like random value. So for instance, what's going to look like, let's execute. Here we have like, we're gonna have different value of Sharpe ratio. Each time that we randomize the portfolio, we are going to get a new Sharpe ratio value. Wow, this one 0.78. I believe it's one of the best. Okay, let's take a look at what is the weight right now. Yeah, we have very few Tesla stock. That's why the Sharpe ratio get back to normal. So it's very interesting. And what we're gonna do, we're just gonna simulate thousands of different weight for the portfolio. So we're gonna have to include all these steps within a function, a book for that we're gonna call for between A and a range of values that's gonna reach number simulation that we're gonna launch. Okay, but already we have a hint. We have 0.78 Sharpe ratio when we have very few Tesla stock in our portfolio. And within this function, between A and number of simulation, we're gonna run the scripts. So, but just in terms of structures, how we are going to structure that, first we're gonna have to call up variable number of simulation, let's say in a range between 1 and 10,000. Okay. And what we're gonna have to do, we're just gonna have to create. Okay, let me explain you what's going to be the strategy. The strategy is gonna be to create different arrays with different portfolio weight. We're gonna have different arrays, and for each array, it's gonna be like empty array. We're gonna have an array with the weights, an array with the return, and an empty array with the volume and the Sharpe ratio. And what we're gonna do at the end, we're just gonna call what is the best Sharpe ratio. And for best Sharpe ratio, we're gonna have the best weight, the weight used, the return, and the volatility. Okay? We're gonna just create like multiple weights, and each weight balancing gonna give us a Sharpe ratio. We're gonna have 10,000 Sharpe ratio. We're gonna call the best one, and we're gonna be able to check what is going to be the best balancing for our portfolio, and that we're gonna be able to do and to use for our current portfolio. Let's go back. So we're gonna just have to create like empty arrays that we're gonna fill each time that we go through the process. Okay, so we're just gonna have to do something that we're gonna call weights saved. So we're gonna save the weight within an array, and we're gonna just for now just fill it by zeros, and up the number, the length of this array, how many rows we're gonna select, number of simulation, gonna give the number of rows in this array, and each time that we're gonna go through it, we're gonna have new value which is going to be stored, and the length of this array is the number of columns. It's we can take portfolio column up, normalize or without, it's just for the length. So up the number of columns. Okay, yalla, let's go. Okay, weight saved. Okay, we're gonna also have our return array, which is going by the same way, it's going to be empty. But right now it's just like one-dimensional array, because we just gonna have the number of simulations. It's gonna be for each simulation we're gonna have like a value. So up. Right now we have 10,000. Okay. Then we're gonna type np.zeros. Up. Okay. And same for the Sharpe ratio. Up. And what we're gonna do right here, we're just gonna, instead of, okay, so here we'll rebalance the weight, and we're gonna save the weight that we use within this variable. Up. So up, we're gonna insert a up, which is going to be equal to the weight. Okay, up. Okay, rebalanced. Okay, good. So here, just to gain time instead of calculation, I'm just gonna replace the variable wt, so we have less variables saved. It's gonna be a little bit more quick. So here we go. Here I'm going to call it weight saved, because what's going to interest us is like what Markowitz is telling us and how we should balance our portfolio. Okay, then that's going to be the expected return. Okay, that we're gonna have to save too. So we're just gonna up return up. We're gonna save in variable a. Here that's the volatility, standard deviation risk, it's just like volatility is okay, so let's call it risk array up, risk array. Okay, let's go. And the last one gonna be the Sharpe ratio array. net return, up, Sharpe ratio. Okay, let's execute. This looks to be good. Let me just check. Okay, yalla, let's go. Okay. Okay, so I think here it's missing just one. Okay, boom, NP zeros, we have 2 dimension. And here we go. So it's going to take a little bit of time. Okay, wow, okay. It's already run. And now let's take a look at what is going to be the Sharpe ratio max value that we're gonna get. Let's increase the dimension because it's too much close to what we found out before. So now it's taking a little bit more time. Before it took me like 5-10 seconds. Now it should take roughly 1-2 minutes. So let's see how it goes. So now that the calculation have been run, we're going to inspect what type of result did we get. Let's check what is the maximum Sharpe ratio. Okay, wow, earlier we went very close to the max Sharpe ratio. Here is like close to 0.78. Let's take a look where is located this Sharpe ratio. Okay, for instance, if we explore. Oh, okay. So here we go. I made a small mistake right there. So we took the latest value of the Sharpe ratio. Okay, that's why. We need to divide the return by standard deviation. Okay, I forgot to change that. Okay, here we go. That's why we went back to the previous value. Okay, let's resimulate. Roughly 30 seconds to run with a MacBook Pro. If you have something more live like a MacBook Air, it's going to be more slow, or if you have like a very small computer, it's going to be very slow. Overall, for MacBook Pro, you can count 30 seconds for 100,000 simulation. So now, let's take a look how our Sharpe ratio array is looking like. Our Sharpe ratio array, as you can see, we have different value of Sharpe ratio. And what is going to be interesting for us is going to be to check what's going to be the max value for Sharpe ratio. Is 1.1. Wow, we already improved it from our latest simulation. And let's take a look on which position this value is. So we're gonna just take a look at .argmax. Same, if you need a small course on how to get better with Python programming, I highly recommend you to follow the Udemy course, which is just below the video. So here, let's take a look at the argmax. It's in 89,638 position. That means like the max value we got it on the almost in the 90,000 simulation. So, and now let's take a look at the weight. Up, we're gonna take a look at the weight, and we're gonna take a look at the weight in the 89,638 position. So, and what we have done here, it's called, just for your general knowledge, it's what we call a Monte Carlo simulation. Why Monte Carlo? Well, I'm not gonna go back on it, it's going to be too long, but it's what we call Monte Carlo simulation in terms of mathematics. So let's run it. Here we go. So in order to get the best portfolio as possible, let's say right now, imagine you have your portfolio composed of these stocks. What Markowitz formulas recommend you to go with, it would be 76% of NVIDIA, 20% of Procter & Gamble, because they are completely uncorrelated, and 15% of Apple. And this stock, you're gonna just keep 1% and 1% of each one of them. So it's very interesting to see what's going to be the best weight here by using Markowitz formula. And for instance, if you want to take a look at the return, we're just gonna type read array, and we are going to explore the array for this argument. Boom, we're gonna get 62% return within this year for a Sharpe ratio of 1.1. If we go back into the Sharpe ratio, we got finally a Sharpe ratio above 1, which is considered good and acceptable by almost all investors. To conclude this video, what we're gonna do, now that we got the new weight that we have to bring into our portfolio, which means we need to change our portfolio from being balanced to have a huge emphasis on NVIDIA and reduce our exposure on Home Depot and Tesla. What we're gonna do, we are going just to show through a graph the impact of the uncorrelation of the portfolio. For instance, if we go, and what we're gonna do, we're just gonna take the return on a column, risk on a column, and Sharpe ratio on the column, and create a new data frame. Don't bother yourself. I'm just gonna go and copy and paste the code. It's very stupid. It's just like bring it that within an array, up, and creating a new data frame with return, risk, and Sharpe ratio for each of the data points. And what we're gonna do, we're just gonna show these data points on a graph. And we should get the same type of curve that we have seen at the beginning of the video in the theoretical part. So what we're gonna do, we're just gonna import Plotly Express up as px, and we just to go quick, we're just gonna type it fig.px scatter df. On the x-axis, we're gonna choose the return. No, wait, on the x-axis is the risk. On the y-axis is the return. And for the color, we're gonna choose the Sharpe ratio. Boom. And let's ask Plotly to show the figure. Let's execute. And here we go. And here's like all the portfolio that we simulate. Here, for instance, this data point is a portfolio which has as a return 17% and as a Sharpe ratio 0.15. As you can see here, the risk involved was very high, so I guess this portfolio should be composed mostly of Tesla stock, which has high volatility with low return. This one should be mostly Tesla stock, because take a look at the return is minus 20%, which means the number of Tesla stock in this portfolio should be high. And our data point, this portfolio that we have here with this return 0.62 and Sharpe ratio of 1.1 should be somewhere right here. Return 0.62 up, yeah, somewhere right there, in order to get this return. Okay, so now we have seen how to modelize our portfolio. And for instance, this application that you have here, you can just copy and paste it, and you can get it and use it for any type of portfolio. The only thing that you're gonna have to do right there is just change the stock that you have in your portfolio, and you can remodelize the stock. You can also include some crypto within your portfolio. And just as an information, you have two acts of improvement of this code. The first act of improvement will be to use logarithmic return, log return, instead of normal return. Where was it? Yeah, here. You can work with logarithmic return here at this specific point. We just took the normal return. And the second axis of improvement will be, instead of having a Monte Carlo simulation, use the portfolio theory equation to have the exact same point. Because here what we do, we just did 100,000 of portfolio, but you can do it through the most efficient frontiers, it's called. Yes, and just if you compare to other video, you will see that the curve is slightly unusual. And one of the main reasons is because in our stock portfolio, we got two extreme stock. One is Tesla, which is extremely bad, and one is extremely good, is Nvidia. Nvidia got more than 300% return. That's why we don't have the curve which is more bomb to the left. We have kind of candy shape, which is interesting based on the stock that we have. But again, when you have point A, point B, the risk will not be a straight line, but will be a bomb where we can find out an optimum value around this point. Okay guys, I hope you like this video and see you in few days in the second video of the channel since I come back. Bye, and also guys, I really love you all and thank you for your support. Love.